Good afternoon. This is Jim Colburn, Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website at commodityresearchgroup.com, where we post our podcasts. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any specific trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is January 18th, and it's just after noon. Andy, it's our
Jim?
first podcast of the year. So why don't we talk about the big three monthly oil reports out of the U.S.'s EIA, the IEA, and OPEC. And I know you go over these really closely, being a barrel counter yourself. What sticks out to you of their first releases for the year?
All right, well, let's start with OPEC. I do want to add that there's another major report that I wanted to focus on, and that's the little one of CRG.
It's
The
a big
big
four.
three plus the
Big,
CRG one,
right.
which I think, I actually have more confidence in our own balances
Exactly.
than some of the stuff that was released over the last week or so. But I'll
Well,
start with
Andy, before you go on, I just have to say, since I would say 2020 with the pandemic, you've nailed the demand side of this relative to these other guys, and year in, year out. So that I think you're being humble, calling yourself the little one, where you can go toe to toe with these guys. Um,
well, that
yeah,
thanks, Jim. We try.
but
We definitely try. It's a difficult exercise, and even
plus,
though I'm now about to bash the OPEC numbers,
yes.
they they still try their best.
Oh yeah.
Um,
No, they're really.
Coming up with these forecasts.
It's
But it's so hard to believe what the numbers coming out of OPEC on their monthly report. They had a huge increase in demand for 2023, up like 2.5 million barrels a day, and then they see another 2.2 million barrel a day increase for 2024. And critically, if you look at their numbers for third quarter, they've got a third quarter 23, they have a draw of 1 million barrels a day. And then in fourth quarter of 2023, they had a 1.9 million barrel a day draw, which I think we could safely say was completely wrong, because all you have to do is look at the price. If we had a draw of almost 2 million barrels a day in the fourth quarter, prices would be much higher. I mean, so the numbers from OPEC are hopeful, fanciful, whatever you like to call it. But I think they got it wrong for last year. And looking ahead for next year, I also think they have it wrong, because they have a huge increase in demand again, which would imply a higher global GDP, a return of of stronger distillate demand, gasoline demand, et cetera, et cetera. And where they have the demand growth, where they have the demand growth is in Latin America, the Middle East, some in North America, not so much in the OECD, and of course in China and India. And they've got draws for all four quarters, Jim. They've got the million barrel a day draw in first, second, third, and fourth quarter, which would mean that OPEC, the producer cartel, OPEC Plus, could easily unwind their current production cuts with no problem. If you believe these OPEC numbers, you have to be really bullish on the market.
Well, Andy,
These numbers would imply, they'd imply $90 crude pretty easily.
well, if we go back to 2023, they had these bullish estimates in their reports, and OPEC plus the entity went the other way. I mean, they kind of didn't listen to this report, and they cut back production, and the market. I mean, they kind of like were the only ones that saw maybe a softening demand or demand numbers that weren't going to come to fruition. I mean, the market.
Yeah,
I mean,
right.
had they not cut back, we'd be a lot lower.
We'd be a lot lower.
And
So
yep,
the producers themselves, they got it right. Or, they expected that with these continuing cutbacks in the fourth quarter, that, they do better on the price because demand would be higher than expected. But you're right, they knew that they had to continue the cutbacks and then add more for the first quarter of 24.
and that's what you think they were going to do that? They're going to start leaking out some barrels over the first.
Well, I think first of all, they have to cut back. So
Right,
it's they
right,
can't leak out before they even
right.
do the cutbacks.
That's true.
And
Yes.
if you look at the last OPEC meeting, they got pledges from a number of the Saudis got pledges from a number of producers, including Iraq, the UAE, Kuwait, Russia, and some of the other non some of the other OPEC plus producers. And so far, you have to say that there's no evidence that the other producers are cutting back. Now it's still early, but we're looking at February and March programs, and I don't see, or I don't think the market sees that Iraq, UAE are cutting back significantly. I mean, maybe Kuwait cuts back some. They did get they did get a bit of a break, call it a break. I mean, Libya declared force majeure on some production because of protests. So that there is going to be a production decline, but I think the market is looking at whether or not we're going to see these cutbacks before
Right,
we even get the leaks.
right. Good point. And I guess we still don't have some Kurdish barrels on the market from.
Right.
Is that
That's 400,000 barrels a day of Kurdish crude, which would be under the Iraq numbers, and Iraq is supposed to be going down, not up. So, and it's probably, I'd have to say that that's probably one of the reasons why the market has really had trouble getting out of its own way. That
right?
they haven't seen the cutbacks. And Russia, Russia pledged an additional two, well, gross of 500, but an additional, say, 200. And they actually may be cutting back, not so much of their own accord, but they've had some trouble selling into India on pricing, and they've also had some trouble on refinery runs. There's a refinery issues in Russia, so it is possible that Russia's cutting back. And that's certainly always a question mark for the market where where Russian production is.
Well, I just wanted to say that since Angola has left the group, are they calling it OPEC plus minus now? Uh,
I don't think that was pretty good. I don't think the loss of Angola is Angola's production has been going down steadily
Right.
for a decade.
Right.
They're pretty much, they're pretty much at 1.1 million barrels a day, give or take. And I don't think that, they're hoping to go up, but I don't see it actually. But yeah, so Angola's out. Just quickly going through the IEA. The IEA also had a big demand number for last year for 2023.
Right.
They were up like 2 million barrels a day. And they think in 2024 it's going to be 1.2 million barrels a day. They just increased it. I guess that report came out today. And finally, the EIA, who I think did the best out of anybody
Right.
last year, because they saw, they basically had inventories building in the fourth quarter. So, everybody else had these big draws, and they had inventories up, something like a 500,000 barrels a day for fourth quarter. And they too had demand. They had demand up 1.9 for last year, and now they're looking for another 1.3 increase for this year. They have interesting. They basically have stocks balanced for the whole year. They have a slight draw, which they wrote about in their in their report last week. They have a slight draw. One of the banks that we follow has a slight build, and CRG. The CRG numbers last year, we had a slight draw for the year, and we thought fourth quarter drew a little bit, drew like 400,000, but I think I, I kept having to decrease the draw, Jim. Kept having to, like,
You
say
increasing.
starting at, like, let's say I thought it was going to be a draw of 1.2 to start.
Right.
And, then I got whittled down to like 0.3 or 0.4.
Hmm.
It may have ended up being unchanged or a build for fourth quarter.
Wow.
Yeah.
It's big, big miss.
Yeah, it was a big miss. And for this year coming up for 24, we see an increase of like 1 million barrels a day. And I also have a slight draw for the whole year. So I have to say, the market right now does look pretty balanced for the rest of it does look balanced. I know,
Well,
I know you
I
don't
got a
like to
little,
hear that, but
yeah,
it does look balanced.
as an options guy, I saw the EIA's projection of Brent prices for 82 in 2024 and 79 in 2025. And I think 2023 they averaged 82. And I'm thinking, you know, sell volatility because we're not going anywhere. But on the other hand, I put a post on LinkedIn, and I love these. The EIA puts out some great stuff, so I'm not trying to, you know, give them a hard time. It's a very difficult thing what they're doing, but when you see a straight line forecast of price for 2 years, kind of that's when I'll get an email from an analyst every now and then saying, I want your projection for oil for this year. And I said, who the hell knows, right? So I'll take the current price and give it to them. And so to me, I was chuckling because they showed a price chart with their projection. So it's a straight line, and it just looks like they're throwing up their arms and saying, we have no idea, we have no idea either. So,
Wow.
which people have been for the last few years. If I can throw a little some vol numbers in here, I do this. I have implied vol data back to beginning of options trading in '86, as many of you know, and at the end of the year, I do a long term average, and for many years it's been around 33%. But after the crazy year 2020 and 2022, the the number has bumped up to 35. So it takes a lot of volatility to bump up this many year long-term average up 2 vol points. So we're coming off of, two of the last four are probably the highest vol years of all time. And to see this straight line forecast, you kind of like a little context, like, okay, what's more important? Is it the price projection or is it the price path? Because we had some people that were talking about a rally in futures prices, and then within a week, China went into lockdown. I think the prices dropped by $20, but then further on, they rallied, and I think the war was around the corner, and so the price, all those price projections of higher prices were correct, but we dropped $20 first. I'd really like to know the path that we're going to go through as much as I'd like to or see the final results. But that's just me because I'm a you know crazy option guy.
Well, you also have to look, yeah, talk about the path. I mean, yeah, the prices ended up at 83 and 78 last year for WTI.
Okay, Andy, we had a little snafu with the internet, so let's continue. You were talking about WTI prices, and I believe you were getting into the price ranges.
Yeah, I was talking about, you were talking about the path, and I was talking about the range from last year. WTI was the low was around 63 and the high was 95. So we had a $30 range. And one could say with some confidence that they think in 2024 the range is going to be narrower than that.
Right.
And after studying this market for decades, I wouldn't bet on it.
Yeah, it's something always happens. Um,
Something right. Something always happens.
what's interesting right now, we have stuff going on in the Middle East, and China demand. There's all the things you talked about going on. Typical oil market, I think, but the the trades that I don't see other than for hedging is like the speculative put buying. So like, say after below say $60, something like that. We have some open interest on those strikes, but that's from a long time ago and was most likely oil hedging. But I would say that's something that the market's not prepared for. You seem to be prepared for lots of upside price going
Yeah,
on.
I'd agree with it's hard to be super bearish here under $60 with some of the developments, particularly out of the Middle East. I guess that the hedgers don't feel like they need the protection for a big downside move. One thing that could certainly change that, of course, is if the Saudis decide that that they want to go full, they want to increase production full bore. This flood the market in the second half. But I don't see that. I mean, I just it's hard to make a case for that. They tried that in 2020 and it didn't really work out so well for them.
Right.
And they've tried it a number of times over the past, during our careers, and
Definitely.
it doesn't see it never seems to work out well. But I think that would be that would be the impetus for a real bear move, coupled with let's say that there's any type of recession. But right now, like you said, Jim, it doesn't look like that flow for taking downside risk protection is in the market.
Yeah, I mean the other story that seems to have gone away, and maybe it's starting to come back again, is the lack of investment in oil. Maybe the increase in U.S. production this year has calmed that down. But coming into this year, there's always this talk that in the future there's not enough money being invested in new oil wells, new oil production. And have you been hearing any of that for say 2025 and out in the out years? That there's going to be the lack of
Not,
capital.
not, not so much as it was over the past, the past few years. I mean, certainly there's been consolidation here in the US, and there've been some, great development. Certainly Guyana's is a incredible story, and the growth in Brazil. I think going for, and the biggest story of 2023, or not the biggest story, but one of the big stories in 2023, which you alluded to, Jim, was the success of US producers. The US killed it, and
Unbelievable.
it was unbelievable.
Yeah, it's like
Yeah,
a.
nobody had that. I
It's
mean,
like,
even
I was going to say it's like another
no, go
revolution
ahead.
within a revolution.
Yeah, I think for a number of reasons. Certainly, the high prices from 2022 did spur investment, and we saw the rig count go up as prices rallied. Now the rig count is off, so the US, the EIA is talking about an increase of only a couple 100,000 barrels a day, and they're actually talking about no increase from where we are right now. I think the last weekly was 13.3. And, I think that's where they're at for next year,
Right.
is at 13.3 million barrels a day.
Yeah,
I think it's going to be higher than that. I can't imagine.
I think in their reports they're talking about the rig counts are going to catch up to the production numbers, so and flatten this growth out. But yeah, it's going to be something interesting to watch. You had mentioned we're going to lose some production from this storm, so we're gonna have to recover that first. That's going to be this month, right? In North Dakota, North Dakota.
The From North Dakota, it
Yeah,
looks like it's 500,000 barrels a day.
yeah. So that's a
And that
significant.
Yeah, it's a significant number. I think that, that should come back pretty quickly.
Hmm.
It's easier to get those wells up, and it's gonna warm up. So I think that's gonna come back quickly. What's not gonna come back quickly, as we've learned over these years, is the refinery capacity that got taken out. There was a report that a million and a half barrels of refinery capacity went down because of the cold weather and the storm in the Texas Gulf. And in the same report, they were saying, "Oh, that's going to come back, no problem." And that rarely happens.
Right,
There's usually problems.
right.
You'd like to think that the refiners are better prepared, and they probably are, because just a couple of years ago they lost capacity for a significant amount of time. But I can't believe that all that capacity is just gonna come back, in the next week or two, and then we go into turnarounds. So it's possible. Certainly, we're seeing the cracks have increased some. I mean, gasoline cracks have been increasing for a while here, which is hard to hard to fathom actually why, but they have been. And
Well,
diesel cracks went up over $41. The New York WTI crack went up over 41, now has set back, but those are pretty good numbers. And the gasoline cracks, they're not, if you go down the curve, they're okay, they're not what they were last year, but they're not bad.
well, I think you're going to get a little bump in gasoline demand from this storm as you know, a lot of these EVs are failing miserably. But
Oh,
that's
oh man, there's a
that's
lot
short.
of
Yeah, short term.
there's a
Um,
lot of disillusioned EV owners, from in the upper Midwest, trying to figure out how they could keep their battery recharging their battery, and that that's part of it.
Yeah.
Owning an EV, and it's interesting that Hertz decided to sell 20,000 of their electric vehicles in their fleet and replace them with gasoline cars, saying that, one, the consumer demand wasn't there, and two, it was costly to fix them. So
Yeah. Yep.
it may not be a straight line up
It
to.
may no, I thought it would be zigzag because of the price of gasoline. I thought once you've made an inroad in, EVs, the gasoline demand would plummet, prices would plummet, and then you say, well, I got to buy uh, a gas-driven car, but it's not working out that way. I think it was the EIA said that 18% of the sales in 2023 light duty vehicles in the US, EVs and hybrids are up to 18%, and in China it's 33%, and they're thinking that it that trend continues and puts pressure on gas demand next year. And my question is, I know you starting to put the EV. You're saying, I think you said before that you're starting to see the effect of EV sales on gasoline demand.
Totally. Oh
Totally.
yeah.
Yeah.
Yeah. Looks like we've peaked in on gasoline demand in 20 from 2016, 17, 18, and 19. The US gasoline demand was pretty solid at like 9.3 million barrels a day. And last year, if I'm right, I think it was 8.8
Hmm.
million barrels a day, something like that. So we certainly we've lost 500,000 barrels a day, and some of that has been some of that's EV demand, and that is going to continue to grow.
Right.
There's no question about that. So I think, you can that one I feel pretty certain about, that US gasoline demand has indeed peaked. There are other factors, but I think we're going to be hard pressed to get an annual demand over 9 million barrels a day again.
Hmm. Just want to throw in some option stuff here. We talked about. Do we talk about the Red Sea? We know
No,
that.
we haven't.
Why don't you want to just sort of recap what you're hearing, what you're seeing, what's being reported?
The well, as I think most our listeners know, the Houthis have been attacking shipping in the Red Sea, and the Red Sea, of course, is a shortcut between Asia and Europe. So 8 million barrels a day go through the Red Sea, both north and south, and certainly a number of shippers are now avoiding the Red Sea and instead going around Africa. It's not a loss of 8 million barrels a day, however, because part of the part of the traffic is this Russian traffic, as well as Middle Eastern production going going through there. So what's happened, however, is it's more of a dislocation. And again, we haven't lost any production at all. So what we're seeing is some dislocation, and the journey takes probably 10 to 14 days longer going around Africa. What's that? What has that led to? Well, it's led to, when you see dislocation like that, usually you see the structure rally, and indeed, the physical market is now above the first futures. The Brent is already heavily backwardated at 50 to 60 cents over. Oman crude too. The Oman futures as well are backwardated, and the physical is over that. So the market is really reacting as one would think. You'd think, however, the outright price would rally a little
Yeah.
more than it has, but we're certainly seeing some big moves on structure. Generally that's bullish. You would
Right.
again,
Yeah.
you think the price would move up,
Yeah.
but we for the time being we can't get out of our own way. Even in WTI, the loss of Bakken has moved WTI from contango to backwardated. So, I think the market is reacting as it should.
Yes, and I have to say the option market has reacted as you might expect, and also kind of that subdued move where volatility was, in the last I don't know month, say the low has been 32%, and now it's at 36%, which is the high in the last month. So vols moved up a little bit, not much. And as I mentioned, the long-term average is 35, so that's not that much. The skew also moved from -4, that would be 25 delta put compared to a 25 delta call on I think I used March options, and it was -4 last week to the put, and that's kind of normal. And now it's -1.5. So the skew went, you know, from a bearish skew to a less bearish looking skew, which was also what you would expect. So, but nothing, and the volume did pick up. Beginning of the year volume tends to pick up, but also with this stuff going on. But you just haven't seen, you know, gigantic plays going on. The paper flows spread out across the board. The big open interest in calls and WTI continue to be the May 76 and a half, 77 calls. And that was like when those giant 50,000, 55,000 call spreads were being done, year and a half ago. That's still on. Maybe that was done more recently in the summertime. But other than that, there's just not a lot of, new option flow causing a strike to look big. There's no big strikes out there. For example, the big put in WTI is 23,000 lots. That's the March 60 put, and that pretty much was done was built up a while ago. And then if I look at Brent options, the big put is the D60 put, 31,000. So that also was done a while ago. And then calls, the March 110 call was 56,000. So, it's again, the volume has picked up, but it's not overreacting to what's going on, put it that way.
Yeah, that's you look at the situation now, right? You would think that somebody would be taking a shot. I
Yeah.
guess it's still the market doesn't expect that there's going to be any any production loss, and that, well, there's a chance, certainly a chance that this Middle East war expands. For now, the market, I think, is relatively complacent. There's always, you know, uh, the one thing that I think the market's been fearing for probably, I don't know, since the 1950s or 1960s would be the closure of the Straits of Hormuz.
Right.
Now there goes 20 million barrels a day of
Yes.
crude and refined products through that's the main, through the Persian Gulf. So that would be, that would be catastrophic. It hasn't happened yet, and hopefully it never happens. But
Yeah.
that's probably the biggest fear right now.
Yeah. And I don't see, I mean, the US putting sanctions on Iran in an election year just doesn't, I mean, I know that's kind of cold, but I don't see that
Yeah,
happening
I
either.
don't see. Yeah,
You
I
know,
don't. I
you,
don't
you
see it happening. Right, and gasoline prices have certainly, come down significantly. The last I looked, the average U.S. price was 308. And that's down from the summer high of almost $4.
So, Andy, after all this, we covered a lot of ground here, and was a little snarky with the EIA's price projections and the IEA talking about a comfortably balanced oil market, and give me some price ranges, going out a couple months. What do you see?
Well, it does look it. Yeah, I mean, it does look balanced, at least on paper. Global inventories are a little on the low side. If you look at US total inventories here are, yeah, actually, they're about a half day supply. They're about normal total inventories. For crude is a little on the a little on the low side, but I'd say global inventories slightly low, but nothing, untoward. My view is more bullish than bearish. If I look at if I look at my own balances, I do see a decent draw in this quarter, and I do see demand increasing in the second half. So, I do like the market to move higher. Can it get to? Yeah, I think it's got a chance to get to 80. 90 is going to have to be better OPEC discipline and much stronger economy, stronger demand, which is certainly possible. And on the downside, as I said, I right now it's hard to trace something below 60. Could it get below 70? Yeah, of course it could.
Yeah, yeah, yeah,
That's
yeah. No,
yeah, definitely,
right.
right? I
Yes.
don't so, I think those are kind of the numbers that I'm working with right now. And yeah, it does look like it's going to be a narrower range than last year, but it's only January, and this is so, we've got 11 months ahead of us of, who knows what's going to happen. And as you and I always say, it's the thing you're not looking at
Yeah. No, that's right.
that
Yes.
happens, right? It's a place where you had no, you weren't even expecting anything.
So
And something happens, whether it's infrastructure or
recession.
geopolitical, yeah,
Yeah.
recession, or
What out of the things you follow, can you rank them as what I mean, you're looking at everything, but would OPEC policy be the most important? These are the desert island fundamental pieces of information that you'd like to see. Would OPEC policy, you want to see the results of the next meeting? Would that be number one? China demand,
what?
U, U.S. oil
Yeah,
production. So how would
I
you
think it
rank
would
those?
be. I think it would be Saudi policy as usual, Saudi slash OPEC policy, because the Saudis really hold the key as to, how they're going to unwind their price cuts, if they're going to unwind their price cuts. So I'd put Saudi number one. And let's, obviously geopolitical, something could happen. We know that, right? There's
Right.
a Middle East, so we'll put that aside on a fundamental basis. Yeah, I think that Saudi policy would be number one. Number two is probably, there's so many non-oil traders in our markets now that I really hate saying this, Jim, but Fed policy is going to be really important
Right.
on flow. Not that I really like to rank that all that high, but it certainly does have the flow behind it. And we'll see how new refinery capacity comes in. There's a giant refinery opening up in Nigeria. So that's I think it's 650,000 barrels a day. It's humongous, and it's
Wow.
starting up. And there's new refinery capacity in China, not so much in China, but in the Middle East. But which certainly will I'd rank the new refinery capacity up there, and Chinese demand, of course, and U.S. How we do, how the U.S. does.
The U.S. Oil production.
Yeah, U.S. oil production.
Yeah. I thought U.S. plus the usual gang, Canada, Brazil, Guyana, as a group to see
Right.
what
See what they
what they
do.
do this year after an amazing year in 2023. Your financial comments, I would just say, you know, whenever I see an analyst, and I posted this on LinkedIn, so I know I'm beating a dead horse here, but whenever I see an analyst use the dollar as a reason for oil movement. I just check on CME has a correlation table, and I looked at it before we got on, in the 30-day correlation for oil with currencies, and they look at the euro. You could look at a bunch of them, but I have the euro, the Japanese yen. It's rounded to zero. If you look at the correlation with short-term, long-term interest rates, it's rounded to zero. And if you look at the correlation with the S&P, it's rounded to zero. So that's that would be without a lag or leads. So I kind of don't look at that as much as a driver of oil markets. And as I always say, if you have a view on a dollar, trade the dollar.
Yeah.
You know,
Well, I'd agree.
yeah,
I guess what I'm mentioning is just these flows that come in.
the funds, yeah, yeah, yeah,
Um,
yep, yep. And
that
does the CFTC numbers, we need to remember that they're as of Tuesday. They come out on Friday. And I just don't understand why in the year of 2024, you can't get a real, you know, release it on Saturday and get Friday's numbers, just doesn't make sense to have Wednesday, Thursday, Friday of trading, which a lot can happen, and then release, numbers of what the funds and the big specs are doing as of 3 days ago. But that's just me. Anything else, Andy, you want to talk
No,
about?
I think we covered a lot.
We
Covered
did.
a lot of ground.
Okay. We'll
Some
be
technical issues, but I think we got through it.
we got through it, and we'll be back next month for the follow up. Another one.
Good.
You can find me on LinkedIn, first of all. That's the best way to get me.
Yeah, you can get a hold of me at first of all, our website, commodityresearchgroup.com, and I am A Lebow at commodityresearchgroup.com.
Great. Thanks, Andy.